Good morning and welcome to the Pennsylvania Department of Banking and Securities weekly webinar series, Midweek Money Matters. Today we'll be talking about different types of retirement accounts and catch-up contributions for those of us who are over 50 years old. We are recording today's session. We will take your questions at the end of our session when I stop the recording, and you are free to post your questions in the chat box, or you can unmute yourself and ask your questions live. So let's go ahead and get started. Today's presentation is going to be broken into two sort of specific categories. We're going to talk about self-funded retirement accounts, and then we'll talk about the employer-sponsored retirement accounts. Both have different types of limits and different tax ramifications. So let's go ahead and get started with self-funded individual retirement accounts. The thing that sets retirement accounts different from the thing that sets IRAs, individual retirement accounts, separate from employer-sponsored retirement accounts are that with an IRA, you make the decision, you hire the person who's going to be the person that you trust to invest your money, and you are responsible for making those deposits for the most part. With a traditional IRA, your deposits to the account could be tax deductible. There are maximum amounts that you can contribute each year. For a traditional IRA, the maximum is $6,000 for 2021. That amount changes from year to year, and it's based on what the IRS announces. If you're over 50 years old, you can add a catch-up amount of $1,000 to your contributions. What's great about an IRA traditional account is that your earnings grow tax deferred and your contributions may be tax deductible. When you open an IRA, you are able to choose the investment type that your money is going into. Depending on how hands-on you want to be, you may be able to do several different kind of options. So it's important when you're looking at firms to handle your IRAs that you consider how involved you want to be, consider the fees that are going to be associated with that, and make sure that you understand the ins and outs of that account. And again, those maximum contributions for 2021 are $6,000 plus $1,000 additional if you're over 50. With a traditional, or excuse me, with a Roth IRA, you can still choose your investment types by choosing where your money goes. However, your deposits or contributions to those accounts are made after tax. What makes that different is that your withdrawals and your earnings grow tax-free. And when you pull that money out, you don't have to pay tax on it again. In addition to that, there's no penalty or early withdrawal if you are withdrawing money from your contributions. You aren't able to withdraw any earnings until you're more than 59 and a half years old, but you can withdraw some of those contributions in the event that you have an emergency. And again, those withdrawals are when you make those withdrawals, they are taxed and they're tax-free. So there's another type of IRA for spouses. So if you're a spouse who is not working, you have the ability for your spouse who is working to be able to make deposits into your spousal IRA at the same rates that the traditional or Roth IRA goes. So you get that $6,000 plus $1,000 if you're over 50. But it allows the non-earning spouse to have the money, to have a retirement account in their own name. It's important to remember that with a spousal IRA, you're either looking at a traditional or a Roth. So very similar to the types of IRAs that we've already talked about, but these are for the spouse. So if you are in that situation, you might want to consider looking into spousal IRAs. So one thing that we don't always realize is that there are individual retirement accounts that can be employer sponsored. The first three we talked about are set up by the account owner. The employer sponsored IRAs are typically set up by the employer. The first one that we will talk about today is the Savings Incentive Match Plan for employees. It's also called a simple IRA. The thing with simple IRAs is that the employer makes the contributions. They can make up to a 3% match if the employee is also contributing to the contributions. If the employee is not, the employer can deposit up to 2% as a contribution into that simple IRA. The great thing about simple IRAs is that the contribution limits are higher than traditional IRAs that are owner owned. So the employer contribution, the simple IRA allows for $13,500 a year for 2021 to be deposited into that simple IRA. If the employee is 50 years old or older, they also qualify for a $3,000 a year catch-up contribution. Now, the difference between traditional IRA and the employer-sponsored IRA is that the employer contribution is tax deductible to the employer. So that's something that employers want to keep in mind if they are offering this type of account to their staff. There's another type of employer-sponsored IRA called the Simplified Employee Pension. The SEP IRA is really for small business owners and their employees. The employer makes the contributions much like that simple IRA. And as I said before, the contributions made by the employer are tax deductible to the employer. They also have higher limits. So for 2021, the simplified employee pension limit is 25% of the employee's compensation or $58,000 per year, whichever is less. Now, one thing that business owners have to remember is that if they're contributing 25% to their simplified employee pension, they also have to make the same contribution to the other employees. So they're not able to say deposit 25% of their salary into their SEP IRA and only 5% to the employees. It has to be the same percentage across the board. So that's something that's very important to remember. And also, again, those contributions are tax deductible to the business. So that's a great tax incentive as far as being able to help out employees and keep the cost minimal to the employer. So there's one more type of IRA that I want to talk about, and that is the Payroll Deduction IRA. So this is also for small business owners, and it offers a low-cost option that employers can offer to their staff. But in the payroll deduction, employees are the ones who make those contributions, and those would be made before the actual taxes are pulled from the employee. So there's that tax benefit as well. Now, much like the first two IRAs that we talked about, the contributions are the same as traditional or Roth at $6,000 a year in 2021, with the additional $1,000 for individuals who are over 50. So with the payroll deduction IRA, the maximum that you can contribute is $7,000 if you're over 50. If you're not 50 years old yet, that amount is $6,000. And the tax benefit then becomes automatic because your deposits to your contributions to your payroll deduction IRA are done pre-tax. So with the traditional IRA that we talked about in the very beginning, the deposits are made after tax, but those contributions are tax deductible if you're eligible to claim those deductions. So that's a big difference. So now I want to switch over to talking about more traditional employer sponsored retirement accounts. And the one we think about most often is a 401k. The reality is that it used to be pensions were pretty common, but over the years, a defined pension has become much less common, where 401ks and other type of employer sponsored accounts are more traditional, and we'll talk about a few of them as we go through. But I want to talk first about that 401k because that's kind of the one that we all know and recognize. A 401k is an account, a retirement account that's available for employees of a traditional for-profit company. The money that comes out of your account is not taxed. It goes, or the money that goes into that you contribute to your 401k is not taxed. It goes directly in before taxes. And then your earnings also grow tax deferred. So you're not paying tax on the money in that 401k until you're withdrawing once you are retired. It's important to note that some companies will match up to a certain percentage of the employee's contribution. And just like the IRAs, there are maximum amounts of contributions that can be made. And in 2021, on a 401k, that maximum is $19,500 or 100% of your total income, whichever amount is less. However, if you're over 50, you can contribute an extra $6,500 to go towards your catch-up. And for those of us who started planning for our retirement later in life, that catch-up amount can really help with creating those assets that we need for when we retire. Now, I do want to mention that if your employer matches a certain percentage that you are contributing, it's important to understand that that match does not count towards the maximum distribution. So if your employer matches the first 5% of your salary, make sure that you take advantage of that full match, because that is free money that you're going to miss out on into your account if you don't take advantage of that. So make sure that you ask your HR department if your company 401k offers a matching plan. So let's then talk about a 403B plan, which is for employees of nonprofit organizations and public school employees. These earnings again grow tax deferred until they're withdrawn at retirement. So it's just like a 401k in that sense. Now, employers may offer matching, but they don't always. And the same contribution maximums apply. And again, that employer matching does not count. So again, if I can just remind us that it's $19,500 for 2021 with $6,500 additional if you're over 50. So let's then talk about a 457B plan. A 457B plan is offered to state and local government employees. We often, as state employees, we refer to this as our deferred compensation plan. The earnings, the money that we put in into those accounts, and any money that's earned as interest, return on the investments, is growing tax deferred. So you don't have to pay tax on that until you make those withdrawals when you are ready to retire. The same contribution amounts apply. So again, it's $19,500 plus an additional $6,500 if you're over 50 years old. The employer may offer a matching contribution, but most of them don't. They rarely do, particularly since they're government agencies. But they do have the catch-up provision. So again, if you're over 50, you've got that $6,500 that you can add to that contribution limit. So let's then talk about, let's make sure that we completely understand that the whole catch-up contribution concept. Um, when we're over 50 years old, we can add extra money to the amount that we're contributing. Each year it's defined by the IRS. For IRAs, for the most part, they are $1,000 a year. So if you're over 50 years old, you can contribute the $6,000 for just as that's what the limits are. And then if you're over 50, you can add an extra $1,000 for catch up. The same goes with the employer sponsored. Those employer sponsored are the catch-up contribution is $6,500. And again, that's in addition to the the 19,500. But it comes in really handy for those of us who, like I said earlier, didn't necessarily plan early on in our careers for retirement. So it can go a long way in sort of helping to beef up what we have so that we're prepared with a livable wage when we retire, or a livable income. So I just want to go back again to passing up the opportunity if your employer offers a matching contribution. Because that contribution is coming from your employer, it's not money that you have had to work for. So depositing that, making sure that you are contributing the maximum that your employer is going to match goes a long way, again, in beefing up that account. And I wouldn't walk away from free money. So we want to make sure that we take advantage of whatever the employer is willing to match. So we've talked a little bit about the tax ramification. It's important that you understand that I am not a tax professional. And there are many things that we need to consider when we start these different types of retirement accounts. all of the employer-sponsored accounts are deposited prior to tax being withheld from your salary. So those funds grow tax deferred until you withdraw the money. When we talked early about Roth IRAs, a Roth IRA is an individually sponsored account, and it's paid after tax, and you don't claim it on your taxes. So what that money is contributed after tax. You've already paid tax on it, and the funds in that account grow tax-free as well. So when you go to withdraw the funds when you're retiring, when you go to withdraw the funds from those Roth IRAs, that money is tax-free. The benefits, you have to kind of weigh out what is going to be best for you. So it's important that you talk to your tax professional or even your investment professional who's helping you with those accounts so that you make sure you're understanding what's going to be the best option for you. Many people look at it and think, well, I'm at, this tax bracket while I'm working, but when I retire, my taxable income is going to be much less, so I'm going to fall into a lower tax bracket. So maybe those accounts that grow tax deferred are a better option. But again, that's a conversation that you really have to have with your tax professional or your investment professional. So you want to make sure you ask those questions. Sometimes we rely on our 401k or our IRAs to sort of become our extra emergency fund. It's really important that you know what ramifications are going to happen if you withdraw from those accounts. It's important that we don't rely on those accounts to be our emergency buffer. And if you are going to use them, you need to make sure that you understand what the fees and penalties are going to be. Often with a 401k or some of the IRAs, the penalties can be pretty steep. And because you are depositing money pre-tax, as soon as you withdraw it, you're going to owe not only a potential penalty, but you're also going to owe tax on that. So it's important that we understand that and make sure that you're prepared if you have to use one of your retirement accounts as an emergency backup. And it's important, again, I go back to suggesting that we talk to that or that tax professional who can help you understand the overall ramification of making those early withdrawals. So I just want to spend a few minutes talking about risk tolerance and diversification. We talked about that early on in our series when we talked about stocks, bonds, and mutual funds. But I want to make sure that I mention it here because when we have these other retirement accounts, we actually have the ability to choose often how our funds, our contributions are actually invested. But we want to make sure that we're comfortable with that risk tolerance. The risk tolerance is basically how much risk am I willing to take in order to have a stronger return on my investment. So it's pretty common that the higher the risk tolerance, the more potential there is for the return on your investment. However, if I am just a few years from retirement, I may want to change that risk tolerance so that I hopefully am able to avoid ending up losing money in my accounts because my risk tolerance was too high and the market took a turn and didn't have time to recover. So it's really important that we understand that risk tolerance. Now, there are some retirement accounts that are based upon when you are estimating that you'll be retiring. So those are called target date funds. And basically what that means is that if I'm 50 years old and I plan to retire when I'm 70, then I am likely going to be retiring in 2040. So that's going to be my target date for retirement. And as I start getting closer to that time frame, my accounts automatically switch over so that there's less risk associated with those accounts. So target date retirement plans are actually kind of cool because I don't have to remember to start making those changes as I get closer to retirement. However, if I am willing to take higher risks and I want to be more in control of my investments, you might not want to have your investments in that target date because you may want to control how much risk you're willing to take. Again, it's completely up to you. We have to make those decisions ourselves. Finally, I want to talk a little bit about diversification. We wouldn't want to put all of our investments into one single place because if that stock doesn't do well and ends up failing or ends up taking a big hit, we may experience a huge loss. If we spread our investments out over lots of different markets and lots of different industries, then when one market isn't doing so well, other industries can make up for it and our nest egg will continue to grow. So it's important that we make sure when we're making those decisions that we are aware of that diversification and we make sure that we're comfortable with that so that we don't risk losing it all in a down market. So let's talk about resources because I always like to be providing resources. The Department of Banking and Securities has some phenomenal non-commercial publications that can be found on dobs.pa.gov. The SEC, the Securities and Exchange Commission, has some really great publications on their consumer page at investor.gov. And finally, a lot of the information that we talked about today can be found directly on the IRS's website at irs.gov/retirement plans. I have some really great non-commercial publications that can help you sort of dig deeper into the types of retirement accounts that we talked about today. As always, I like to mention our Office of Consumer Services. They are open Monday through Friday during regular business hours. Our staff are happy to answer your questions, help you with understanding what may be happening with your accounts. They can verify your investment is legitimate, and they can offer assistance if you have a complaint about an investment professional, non-bank lender like a mortgage broker or a pawn shop, check casher, or other types of companies like that, or even about the banks and credit unions that we make sure are financially safe and sound. So just remember when you call 800 PA Banks, a real life person answers your call, and the call and our services are always free. So feel free to give us a call and ask us those questions that you may have. This concludes today's session of Midweek Money Matters. I am going to stop the recording. If you have any questions, we are happy to take them once I get the recording stopped.